Hi, everyone. Many thanks for joining Carbon Tracker's webinar this afternoon, which will be discussing our latest report, Navigating Peak Demand. I'm Evgenia from Carbon Tracker's communication team, and I will be briefly introducing the session today. So the runtime for today's webinar is 1 hour, and the agenda includes a brief presentation on the key findings of our report by report author and head of oil, gas, and mining, Mike Coffin. We'll then be joined by Harry Benham, who's the energy transition advisor to Carbon Tracker, for a short discussion. And finally, we'll end with a Q&A by you, the audience. So at this point, we kindly ask if you have any questions to submit them through the Q&A function found at the bottom of your Zoom screen. And do please include your contact details. So if we don't manage to answer your questions on the live Zoom, we can then reach out to you and answer after this webinar. Thank you. And Mike, over to you.
Great, thanks very much, Evgenia. So we released this report, Navigating Peak Demand, a bit over a month ago. And what I'd like to do today is really just talk through some of the high-level concepts in that report and some of our high-level findings. And as Evgenia says, we can then move straight into a discussion between myself and Harry, and then we'll really look to open the floor up to Q&A from the audience. As I say, really high-level, just want to touch on some of the key themes and really introduce the report, which obviously, as always, is downloadable from our website and is freely available to all. So, first up, it's clearly the energy transition is being driven increasingly by new technologies, particularly renewable electricity and the development of other technologies such as batteries and storage and grids, and ultimately the electrification of the energy system, moving away from a fossil fuel system. So if we just look at, for example, here, some work from Arena, looking at in green solar PV and offshore wind and onshore wind, the LCOE of electricity for those selected sources has fallen dramatically, in some cases nearly tenfold over the past decade. I would expect, whilst the slowdown of a slight slowdown of this into the future is still learning curves for renewables and many other technologies too. So the transition is being increasingly ever furthered by technological development, but of course also supported by climate policy action, which initiated some of these technology developments, but have now, which are now in their own right driving forward and reducing cost. And of course, it's not just the renewable electricity provision and developments there, which is driving the transition forward. It's also technology development, as I say, with batteries and electric vehicles. So I've included a slide here from our automotive team and the most recent report, Driving Change, released 2 weeks ago, where we look at the vehicle fleet forecast for global north and China. So I'm not going to go through the whole chart here, but what's key to note is that over time, while overall vehicle fleets may be growing slightly, clearly there is a shift from internal combustion engine and hybrid vehicles towards battery electric vehicles. And the key line on this chart is that line in dark blue through the center. So we've seen growth over the past 5 years of internal combustion engine fleet, but that is very much plateauing and peaking through the middle of this decade, and will then fall rapidly through the 2030s and into the 2040s. And of course, with ground transportation providing providing around 50% of the demand for oil, particularly, this shift in the electric vehicles will have a profound effect on global oil demand. So I think, so moving on, to the next slide here, is we've got renewable electricity, we've got new technology development in batteries and enabling technologies and grids and other forms of storage, which is ultimately driving peak demand for oil and gas. And of course, coal itself has peaked already. This chart we've just taken straight from the International Energy Agency's most recent World Energy Outlook. And what it shows is their three key scenarios: STEPS, which is their slow scenario, announced pledges scenario in yellow there, which is their moderate scenario for the transition, and then their net zero emissions by 2050 scenario. And actually, under all of these scenarios, all three of these fossil fuels are now expected to peak this decade. So we're moving away, even in the slow transition scenario, from growth in oil or even in gas long term through this decade. Now, of course, under the slow transition, the demand doesn't fall as fast under steps as it does under APS, and nor as fast as under the NZE. But the reality is oil and gas demand is expected now to be falling over as we move into the 2030s and beyond. And the question really comes down to what is the pace of that demand destruction? And because of this, there is a real risk of overinvestment into the industry, into oil and gas production. And this chart here shows just for oil, and those of you who've joined our webinars previously will be familiar with this plot. But what we're showing is a future production in the dark grey from existing oil fields that have already been sanctioned and developed against 4 different transition scenarios for outlooks, for oil demand out to 2050. We show here the stated policy scenario there in the red, and then a moderate transition and a fast transition scenario, not from the International Energy Agency, but actually from the UNPRI's Inevitable Policy Response Programme. Those scenarios we think particularly represent the non-linear nature of the transition and the rollout of these new technologies, and particularly also in this case, the drivers that policy and increased and enhanced policy action, particularly around climate, will have on demand for these fuels. We also show there in yellow a rapid transition scenario, which is the Oxford Institute for New Economic Thinking's FAST scenario. And the point here is clearly there's a massive difference in the space and the compatibility of any new projects and new developments under any given demand scenario. So looking under that moderate transition, the purple scenario, there's less than half of the projects that will be viable under slow transition, and under the fast transition, just a very small proportion of potential new projects could be viable and under a fast transition. Of course, with the rapid transition, we already have enough supply from existing projects to meet demand as in a rapid energy transition. So given this risk of overinvestment, what should the companies be doing about this? And ultimately, companies need to be planning for falling demands. Now, the key question is, what is the pace of that demand falling? And this first chart is really one of the key charts from the report, or key images, where for companies, for oil and gas producers, now whether they're pure play companies or integrated companies, ultimately the response to the energy transition challenge is around the pace at which they see their upstream production declining over time. Now, it may be that the companies see that plateauing for many years or even a decade and then decline, but at some point their production volume will decline as a result of or need to decline, as a result of the substitution effects of renewables. So there's a spectrum obviously here from declining production on the left to increasing production on the right. And we identify sort of five specific strategies from the left: also an accelerated decline, a natural depletion strategy in the center there in the light green, where you have no new developments of projects, but existing production is operated, it declines naturally. Obviously, that involves stewardship around methane emissions and other environmental and social impacts. And then you have 3 strategies of continued development on the right. First, a managing investment in blue with some limited development and exploration, a business as usual replacement strategy in orange, and then a growth strategy in red. And indicatively, I've put some company logos on the bottom, really just to illustrate where we see companies in this spectrum. Clearly, Ørsted has left the industry, but it's often still cited as a company. So I think it's still, and as a company that has effectively transitioned away from being an oil and gas producer. So it's always worth just putting that there on the diagram to illustrate. I've then put the majors plus Aramco in an approximate position of where we see their sort of strategy on the upstream business at the moment. So the second key chart from the report is looking at how ultimately a managed investment approach reduces risk exposure. And these 2 charts, again, I won't go through them in complete detail, but on the left you have a managed investment case out to 2029, where companies just focus on the development of short cycle projects. So, for example, shale or very near term sort of small scale tiebacks to existing infrastructure, as opposed to on the right, a business as usual investment process out to 2029, where projects up to $50 a barrel, all projects, conventional projects as well, are sanctioned. The same scenario, that forecast policy scenario from the Inevitable Policy Response Program is shown on both. But under the managed investment case in the left with the blue additional supply, it broadly balances supply and demand out to 2050, whereas on the right hand side, business as usual investment by the industry, even just over a 5-year period to the end of the decade, significantly oversupplies. And of course, that oversupply will depress prices, as indicated on the two charts. In the report, we also consider the implications of these two investment cases under the fast transition scenario as well. And of course, the level of oversupply is greater in both investment cases for that, and of course, consequently, even lower and more depressed pricing. But of course, even a managed approach may not result in a sufficiently swift exit from the sector. Currently, we're seeing, and yet again, seeing more announcements of OPEC around withholding production to bolster price. As the transition accelerates, we see that petrostates' market share increases. Yes, overall volume may decline, but the market share of production by NOCs and OPEC plus members will increase. And I've shown a chart there on the right where particularly under a moderate transition, and this is in revenue terms, and it's from a report we released today called Petrostates of Decline. But under a moderate transition, the revenues and consequently production is really concentrated increasingly concentrated, within petrostates. As a result, listed companies are increasingly exposed as demand starts to fall, ultimately exposed somewhat to the whims of OPEC. And in the report, we really touch on some of the dynamics here around, well, ultimately, if OPEC seeks to maintain market share and actually wants to monetize resources against the backdrop of declining demand, actually, in some ways, all bets are off in terms of what that may do to price, particularly through an extended period if they look to gain market share. And again, of course, further technological innovation and policy action on climate is likely to further accelerate the transition. So in this context, what do the investors do? I mean, it's critical that investors seeking to understand the implications of the transition and the pace of transition and the extent to which these exponential growth curves could really impact and weaken oil demand. Investors must ask these questions of companies. What are the demand scenarios that companies using in central planning cases? What is the company's production plan? To date, just 3 of the leading oil and gas companies have indicated that their oil production will actually fall. It's hard to see how that's compatible with some of the overall industry demand trends we've just seen. At an individual company level, are individual developments sufficiently insulated from long-term price falls? And what about the viability of new exploration, whether that's greenfield, brownfield, in existing basins, and certainly thinking about access into new licensing in new basins, where it may be from the award of an exploration license 5-8 years plus before first production, of course, then peak production after that, and then 15-20 years of full production thereafter, taking you well into the 2040s and beyond potentially. But of course, asking questions of companies is one thing, but what's also absolutely critical is that analytical techniques and investment models are updated to reflect this. And we think that investors should be moving towards a default modeling that incorporates a moderate transition scenario rather than a slow one, ultimately as a result of the demonstrated progress that we've seen over the past 5 years and are expected to continue to see in terms of rollout of these new technologies. Price forecasts, it's critical that those are consistent with the expected pace of transition. If we're looking at a moderate transition, then that would, or even a fast transition, that would expect to see lower long-term commodity prices. And it's really important that models reflect and have consistency between those two. And then finally, obviously, it's critical that appropriate terminal values are used within DCF modeling. And then, so how else can what can Carbon Tracker do, and what do our analyses do to help support investors in terms of analyses, analyzing these companies? Well, we've got 5 main metrics, and again, frequent viewers of our work will be aware of these, but I really want to reiterate those here. First, it's looking at production plans, capital allocation, thinking about emissions targets. And while we're here focused on risk, actually for companies, we see that emissions targets that they've set themselves are in some ways a proxy for production plans, particularly if they involve scope 3 emissions and on an absolute basis. Those conversely, companies that have not set scope 3 absolute emissions targets are effectively not setting absolute production targets. So again, if they haven't set that, are companies planning for production decline at some phase? Fourth, remuneration. We think it's critical that personal incentives support strategy, and our Crude Intentions series writes about the importance of remuneration actually backing up strategy, whatever that strategy is. And the disconnect there is hard to unravel. And then finally, the work that our accounting and audit and disclosure team look at in terms of climate risk disclosure, it's critical that there's adequate reporting, adequate sensitivity analyses, and these are being disclosed to investors, but also that, for example, the auditors are actually performing their duty appropriately. So we've talked about the pace at which upstream businesses need to or potentially consider exiting over time upstream production and allowing that upstream business to decline over time. But the question then becomes what to do with the capital that's historically reinvested. And there's no right or wrong thing to do here. And ultimately, there's a spectrum between returning capital to shareholders, either through increased dividends or through share buybacks, or by diversifying and investing in new businesses. And of course, those new businesses, there's a whole host of them that they could be. It doesn't have to be renewables generation. There's other supply from a consumer basis, thinking about sustainable fuels in terms of things like green hydrogen or ammonia and other biofuel or biofuels. Some companies are seeking to pivot towards chemicals and be part of that broader petrochemicals value chain. And others are looking to, for example, carbon capture and storage as a decarbonisation service to other industries. Now, each of those has a number of challenges, but they also have potential opportunities for companies. But I think the critical thing is there is no one-size-fits-all strategy, and any transition frameworks and assessment frameworks, we believe, must be strategy agnostic, ultimately assessing the risk of continuing to invest in the legacy system, and then looking at the opportunities for the new system. But of course, we see companies, and I've just put a few examples there. Obviously, you've seen today, also very recently, BP increasing its stake in Lightsource, for example. You have Total, who's looking heavily at hydrogen. You've got Shell Energy, and I've just got the clip there. Well, actually, Shell Energy is a sort of a retail distribution business to set up, but actually is now fairly shortly thereafter exited. And then on the bottom right, Saudi Aramco is certainly looking to increase its chemicals production, has big plans for increasing the yield, the chemicals feedstock yield from a barrel of crude. The question, of course, it becomes one of, if you have feedstocks now at 8%, can you really get to a yield of 50% or more, which is being touted? And what is the cost of doing that? So the key questions are for investors around this are, what are the technical and commercial advantages does the company have in the proposed new business area? Are they able to transition in time? These are big companies with big corporate identities. Can you transition into fundamentally different businesses? In some cases, utilities as opposed to utility-like businesses. What are the barriers to entry? Are particularly for other entrants to those. So, what advantage do these companies have? And then also, how will new businesses complement each other? At the moment, for some, it appears a strategic shift into a whole set of different businesses. But then the big question ultimately for investors should be, would a cash out strategy actually be value generative as opposed to a diversification strategy? Again, while company leadership may wish to transition, actually, is that the right business model for investors? And we see, this is a chart from the International Energy Agency. You see oil and gas investment falling as a proportion of overall spending, but that saving on spend on oil and gas is not being spent into low carbon capital expenditure, as shown here with the very thin light blue bar. The reality is that value is being returned to investors. So while companies may be a stated strategy of diversification, the reality is that we are seeing companies start to take, or certainly starting to take, a more managed approach, and they have been doing so over the last 5 years or so, and obviously continue to need to do more. But that money is not being diversified. In general, that is being returned to the investors. So one thing I wanted to highlight just before closing out and moving to the Q&A was our refreshed company profiles. So we've had company profiles on Carbon Tracker in the past, and we're looking to refresh these and release these coming soon in Q1 next year. And the intention here is we'll have a single company profile, taking the key Carbon Tracker sector metrics and looking at those at a company level. So wrapping it up as a one-stop piece, decisional useful analytics for investors that complements our sector research. And they'll contain critical review of strategic plans, analysis of transition risk exposure, particularly focused on capex and production, climate alignment in terms of emissions targets for those particularly for environmental funds or exclusionary mandates, and then also particularly looking from a debt investing perspective or financing perspective. And then we'll also review governance both from a remuneration perspective, but also from our accounting work too. And then finally, of course, key questions stakeholders ask. So please do look out for those coming in the new year. So before I close, just to really sum up the key takeaways from today and from the report. It's transition is driven by tech development, and increasingly so. Substitution of fossil fuel demand impacts price, returns, and ultimately risks weighting significant capital. Really important to have coherence between commodity prices and the view on the pace of the transition. If commodity prices used within modeling and the view on the pace of the transition. Because diversification is hard, there are opportunities out there, but companies, it's demonstrating it's hard to diversify big businesses and pivot big businesses, and a cash out strategy may actually be in investors' interest. Finally, policy action likely to accelerate, and companies increasingly exposed to the OPEC actions and potentially OPEC whims as the transition unfolds over the next 5-10 years. So thank you. Let me close there, and Harry, I'll pass over to you at this stage.
Thanks, Mike. Hopefully everyone can hear me. Just a reminder, if I'm going to abuse my position and ask some questions of Mike for a few minutes on this report. But if you've got any other questions that you'd like to put in, either on what Mike's presentation or what we're about to discuss, then please do so. I'm going to start with a couple. I mean, Mike, I had the luxury of being able to sort of work with you a little bit on this report. I've read it a number of times, but I still get more and more out of it. But I guess let me sort of start where you left off, which is I think Carbon Tracker has put in a lot of effort. I come to it as a sort of advisor, so I know that the team are working it hard into trying to steer a rational way through this peak demand. And I think some of the questions we still get is it's kind of in the report that peak demand is becoming less and less of a scenario now. It's a reality that has to be navigated. It has to be worked through, and the risks need to be understood. So a sort of drill and hope mentality that's still quite prevalent from what I got from your analysis is quite a high risk venture for stakeholders and investors, given that the kind of returns are, not that far above renewable returns these days, given all the the volatility. Why do you think, Mike, to you, and it comes out in your report, why do you think that the kind of clarity about this demand coming and that this transition is coming has intensified over the last year or two? And also, it seems to have accelerated. Every year, the peak seems to be coming forward 2 years, etc. Is that, I guess, not answer my own question, but do you feel that the data that we've kind of projected in the past 3 or 4 years is now actually coming home to roost, and that we're starting to see a lot of these scenarios becoming the actuality, but the reaction to them isn't as quick as you would hope, and therefore people are running out of time to make really good choices?
Yeah, gosh, thanks, Harry. There's a lot in there. I think what we have seen, and if I just reflect on my time at Carbon Tracker over the past 5 years, what we have seen is the projections have been brought out, but more so than so every year it's exceeded those projections. But we now have that data is really defining a curve. So if you look at the EV rollout in Northern Europe particularly, so clearly in Norway something like 80% now, and in the UK it's more down 30-40%, but it's clearly following those curves, and we show that in the report. And of course it took a long time to get going, but of course that's the nature of exponential growth. But I think also it's just a reflection on in your point there on psyche is almost yes. And I think I in fact heard, I think it was Nigel Topping at a recent conference say it takes a lot, going from 1 to 2 or 0.1 to 0.2 to 0.4% is doubling, but you don't really see it. So we're still seeing that same doubling each year, but you're just now really seeing it. It's actually having that volume. So I think it's hard to predict. It's often hard to sort of see, okay, it really could go at that pace. Even that's what the data is indicating. But of course, we've now seen that data saying even more that we're on those trajectories.
Yeah, thanks, Mike. Yeah, you're right. The old phrase is gradually then suddenly, isn't it? When you start to get that doubling effect. I mean, do you see, you mentioned a couple of times, and I thought it was very marked when you said that, it's now kind of, there's always this mix between policy, environmental concern, and then passing on to economics and then technology, etc. There's that mix in there as what's driving this kind of rapid change. You mentioned the technology side is really grabbing it. So in that kind of policy versus technology, is that a factor in there? Are things like wind, solar, and as you mentioned, EVs, are they now starting to almost have a life of their own that's driving this change? And so even if people are sort of attempting to stop policy or incumbents starting to push back on policies, there seems to be renewables, spend of whatever it is now, like 450 billion, bigger than oil and gas capex last year. Is that now starting to have a life of its own that's taking off and is driving this? Because you mentioned it right at the top of your conclusions, which is very interesting.
Yeah, absolutely. I mean, I think we've now seen, and the IEA made clear they're finding that clean energy investment outstripped oil and gas investment for the first time in 2022, and expected to see that sort of that delta grow even more into 2023. So I think, and there's obviously speaking to colleagues and our research more broadly in Carbon Tracker is very much seeing that, okay, well, you've had initial subsidies to get the costs down for these technologies to the point where they're commercially viable in their own right, which is further driving down costs. And of course, these technologies, as they continue to scale, will continue to have economies of scale and spurn others. So, for example, and while not an area of my expertise, clearly with battery technology, we are seeing there are a whole new forms of batteries coming through too, which potential to reduce the cost yet further. So absolutely, we're in a stage where that delta is only growing, and I would expect to see that the renewables investment continuing, and clean energy more broadly continuing to outstrip by a greater margin ongoing oil and gas investment.
Thanks, Mike. So I'm going to ask one last question to you, because we've got a number of questions coming in, and maybe if I could start moderating those, I'll let you sort of also have a look at them as they come in. But the one I wanted to bring in again is, I think you made the chart I like the most is they're all good charts, but the chart I like the most is the one about the options, because you're trying to sort of say to the oil and gas industry, really, you need to sit down and actually start facing reality, have a good hard look at yourself in the mirror, is kind of how I took the tone of it, which is quite right. Stop this kind of hope and start to get into reality. This notion that cash out versus diversify. If I was being brutal, I would say something like the boat to diversify has long gone. It's left the port, and really it's now about managing what's left. But do you think? I mean, some of the investments in technologies like CCS or looking at these other let's call it, they're kind of immature technologies. Is that really the way that the oil and gas companies should pivot into that area, or really should it be, look, that might have been a nice idea 10 years ago, but now you should really start to become more spreadsheet focused, terminal values back into cost, and actually just sit down and do the hard sums now. I'm afraid we're beyond the kind of, the little dreams.
So I mean, I think we're kind of clear. What we're not trying to say what they should do. I think what's really important is consider these options. But I think it's also a message to an investor framework, and you see all these guidance documents on oil and gas company transitions, oil and gas, what they should do. And I think that's why I really focus on this two-part framework. Is one is, okay, ultimately the speed of exit from oil and gas production. I mean, even Exxon CEO is finally saying, well, oil and gas demand will fall at some point. Clearly the question is what pace, but separate that from the what do you go and do next. So there are a lot of frameworks out there, and even things like there are frameworks that look at overall emissions intensity for judging transition. But of course, such frameworks presupposes that oil and gas companies must become renewable energy providers, but they can diversify into other things. Provision of CCS as a service to decarbonize the hardest to abate sectors doesn't change your emissions intensity for your production. So it's really important that we don't force companies to pursue strategies that may not actually be beneficial, which are not beneficial to investors or actually even to climate interests either. So I think it's important we don't have misguided, we don't push companies into misguided ways. In terms of some of those technologies, you only have to wind back 2 or 3 years, and I think there was a lot of interest in hydrogen for light transportation, but over the last 2 years, I think it's becoming increasingly clear that battery electric vehicles rather than hydrogen fuel cell vehicles is going to be the predominant and the most cost-effective technology going forward. So actually, those who've invested in hydrogen, looking at potential massive growth, I think will be left a bit high and dry, but that doesn't mean there aren't niche or relatively niche applications for hydrogen and for many of these other fuels. I think it's just identifying those, and as I say, identifying those where companies have a commercial or technological advantage, and to go into that area, and that could also obviously be geographically related as well.
All right, Mike. Thanks so much. That is interesting. That is interesting. I'll turn now to some of the questions that are coming in, because I feel that I've monopolized this conversation. One we've sort of covered already about should oil and gas companies partner with renewable firms or invest in them, etc., to move out. And these are ways that we could do that, and we can answer that maybe in slightly more detail. But another question that comes in, which I think links to your most recent report yesterday, the Petrostates one. It says the question is for those that can't see it. NOCs and international oil companies own the majority of share of global oil and gas reserves. Why the focus of investors and other stakeholders is still into the majors listed companies? Should the focus be more on government countries who own these reserves? And there's a kind of add-on question that says, what part of the oil and gas industry will be the last to get stranded? So this IOC, NOC shift that you mentioned there, would be the stakeholder strategy for recognizing that shift of OPEC becoming a bigger share of the dwindling production base?
Great. I mean, there's a lot in those two questions. I'll try and touch on it all. So the NOCs and IONOCs own a majority share of the reserves. Absolutely, and their share of overall production we would expect to grow. I think there's a number of reasons that, in part, some of the largest and easiest to develop hydrocarbons are in NOC hands. But also, there's just got to be this recognition that these companies and the states themselves own these resources fundamentally, and they can monetize them. They can accept monetizing them at a lower internal rate of return projects than listed companies and investors into listed companies would demand. So that increasing market share is what you would have seen to expect. In the question of why would investors focus on the majors and other listed companies? Well, because ultimately they can't invest into many of the NOCs. I mean, yes, some of them are partially listed, and Aramco has a small listing, and others with significant state ownership, so Petrobras and Equinor and others. But it's also in terms of influence as well. Actually, if you're investing in these companies, you are still ultimately at the whim of the NOC and the government, and the potential opportunity to at least actively own that is limited. In terms of the stranding, which would be the last part to get stranded, well, in some ways, I think it's important here we think about, generally when we're talking about stranding, we're talking about the oil and gas production that becomes no longer financially viable on a full life cycle basis, ultimately because the revenues are lower than expected because of lower commodity prices, a result of weakening demand. Now, of course, that's separate to assets becoming stranded to the point where they actually have to close in because they're no longer profitable point forward. But if we think about the first part, then what would I see as the last part to get stranded? Well, those lowest cost projects in some of the simplest development environments, and some of these long-term projects may already, particularly existing projects, may already have met their sort of financial expectations, and so continue to produce and then late life projects. I think the first parts to get financially stranded are, I think it's an important point to work, are long duration projects in complicated development environments that are expensive, that may not start production for a number of years, potentially at the point where there is already significant downward pressure on commodity prices in a post-peak oil, once you post-peak demand through the latter part of this decade into next. And again, we talked about oil a lot, but I think also that thinking there of complicated, expensive, long duration, things like LNG we see as particularly exposed as well on a long-term basis.
Yeah, I mean, we may have seen the end of ultra deep water, as some say. I think we've been some questioners have been bold enough to use their names, so they'll get preference here. Laura Kunstler Brooks, Mike, this is topical. Looking at COP28, do you expect a decline in national ambition, and do you expect the net zero scenario will therefore be less likely?
Yeah, good question. I mean, I think what that does is, I think that brings us back to our policy versus technology point. And so if you just think of NZE as a fast transition scenario, and you could even strip out the emissions from that and just say, well, it's a 1.5 scenario, it's similar-ish to the IPR's required policy scenario. But again, if you just think about that as a fast transition driven by technology development, then actually in some senses the national ambition around phase out may potentially has less of an impact. So I think it really depends on the pace of transition you see. But what I would say, if there is a decline in national ambition, then yes, there may be some there may be future policy action that would help accelerate the transition further, may be sort of weakened. That said, we're continuing to feel the physical effects of climate change ever stronger, and I would expect there's still, even if there is an agreement now, the fact that you will need to see strengthened policy action over the coming decade as those physical effects are increasingly felt.
Thanks, Mike. We've now a friend of the podcast, Simon Perham, has sent in a number of questions. Let me just pick two of them at the moment. The IEA predicts, and this is an interesting point, and it comes to your point about pricing, Mike, that you touched on there. It was quite a sharp decline in price, which may have caused an intake of breath in that those scenarios. So the IEA predicts EV deployment, for example, will knock 5 million barrels a day off demand by 2030. There's other reasons for demand to come down as well. Ukraine war, we've talked about, etc. The last time we saw that was COVID, and future prices turned negative. And so would you be, just for, again, from the investment side, it reads almost a broader point. Sometimes people read peaks as well, okay, and then it's plateau, and then it's a smooth transition. But peak could result in a very volatile outcome, which you've sort of suggested there when you look at the pricing model there. So as we reach a peak, and then, as you said, maybe how does OPEC react? How do others react? Investors react? Do you see peak actually not being this kind of just a passing footnote? It's actually heralds a more volatile investment, context for investors and for the companies themselves. And so it's actually a big deal at the peak.
Yeah, I mean, I think, oil markets and commodity markets more broadly inherently volatile. And I think particularly for oil and gas, you have the time frame it takes to develop, and thus the ability to react and to moderate, particularly to short-term shocks, is clearly that isn't going to go away, and potentially it exacerbates. And I think there is a difference, obviously, in that weakening demand will be over a slightly more extended period, so you may not see those shocks and quite the same price impacts. But ultimately, it still requires planning to avoid oversupply. And then obviously there's the benefit of, if you're going to do some new projects, shorter cycle projects and smaller, lower capital intensive projects are potentially give you more flexibility. And of course, we've seen that from the industry as a whole over the last few years, but it needs increasingly so. In terms of the impact and the potential for countries to the markets to be impacted by OPEC, I think, as we touched on, I think you've seen those continually. We've seen a number of kind of steps to withhold supply, and once you are over that peak, and if oil and gas declines naturally at 4, 5, 6, 7% over time from production, at the point your decline is potentially going at a similar rate, there's little demand for new projects. I think OPEC does hold a lot of power there, and I think people, companies, and of course then in turn investors can be particularly exposed.
Yeah, I think that's right. I mean, I'm conscious of time. It's a good answer though, and that OPEC spectre is a really important point. I'll give preference to people that put their name there. For those that we don't answer, we will please send in your email addresses and we can get back to you. Let me just try a quick one now. I think from Eduardo de Lima. We've seen some majors de-risking by selling upstream operations to others, but securitizing long-term supplies from the same oil and gas field. Is that, any comments on that? Is that a way around this, or is that just it doesn't really change the dynamic?
Well, I mean, I would talk. So obviously, often existing operations can be, particularly later life fields, can be more expensive to operate. And it's actually, particularly for those looking to de-risk from a reputational or environmental perspective, or even a climate perspective, clearly selling those assets to somebody else does help de-risk in a number of those different ways. Whether, of course, those actions are credible from a transition plan, and I think if you look at this from a climate transition planning perspective, are those actions credible in terms of, say, achieving emissions targets? And clearly the answer is no, or at least your emissions targets need to be adjusted accordingly to reflect the kind of the asset sale. But I think there is an opportunity there to de-risk, yes. But as I say, I think particularly from a climate perspective, that's where the credibility is potentially a bit more challenging. And in terms of the specific nature, sorry, I didn't answer the securitization point. I think it would depend on the specific terms of that. I'd need to want to look at the specific examples, I think, before commenting further.
Thanks, Mike. I'm going to try and wrap it up. I see that Kirsty Kesakalo has done a little trick at the end there by putting their name so that they get a preference for a question. Well done. What I'll do is I'll wrap that up, and Simon had mentioned one as well. Just last question for you, Mike. We're sorry we're out of time, and obviously we can follow up, and it's great that Mike's report has simulated all the questions. I suppose I'd blend that with Simon's about in terms of mergers, acquisitions, consolidation in the sector. We've seen some activity, obviously, in the US and the shale with Exxon and Pioneer, etc. Kirsty's question is about might we see some of that in Asia as well? Do you see one of the reactions to this, Mike, potentially even to your report, being that it might stimulate some consolidation in the sector, and also would that help?
Yeah, I mean, I think the M&A activity we've seen from Exxon and Shell, or the kind of the indications, Exxon and Chevron, is certainly indicative of ultimately a rebalancing of their portfolios to have a more shorter term nature, particularly with the acquisitions of two organizations with significant shell portfolios. And sort of work with colleagues as well has looked into this in a bit more detail, but also thinking about the nature of those deals in terms of the stock transfer for those as well, potentially kind of reducing risk exposure somewhat through the transition. What do I think in general? I think I would expect to see more consolidation in the industry over the years to come. And is that a good thing or not? Well, I suppose in a world of decline, particularly as the listed company proportion of production shrinks as well, and potentially shrinks faster than likely to shrink, faster than overall supply, you would expect to see continued consolidation to maintain effective economies of scale through the management operatorship of those fields. From a climate perspective, a bit more uncertain. Obviously, the larger companies and the listed companies do have more scrutiny when it comes to, say, methane operating standards. So in general, it's probably preferable that the existing assets are stewarded by more responsible operators rather than being sold to, say, to some companies, whether that's, for example, private equity operators or other, who have a lower degree of scrutiny and lower sort of operating standards too.
All right, thanks very much, Mike. I noticed that Evgenia has rejoined us. We're probably finishing up one. Pablo has asked about whether we see prospects different, whether you're upstream, midstream, or downstream. My own personal view would be not really significant. It goes through the whole chain. We're seeing refineries, petrol stations, and upstream projects all being in decline. But that's maybe a discussion for another day. But I don't think anybody escapes. Nobody gets out of this one. Thanks so much for taking your time to present that and also answer on your feet there. That was great. I learned a lot from the report and also from what you've said there, which is great. Super. Thank you very much. Hope the audience got some good. Remember, it's on the research tab on the website for Carbon Tracker. The Petrostates report just released today. The Navigating Peak Demand released a couple of weeks ago. And there's a lot of sort of comments you can make there as well. And you can follow up as well.